Welcome to Taking Stock for the week ending the 27th of May 2022. We're joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. It's great to have you on board again, Jace.
Thanks again, Kien.
But before we get started, we want to remind you that the information provided today is of a generic nature and therefore should not be considered personal advice. Any tables and charts presented today are based on historical data and should not be relied upon as a guide for future performance. Well, Australia has a new government, but as highlighted last week, the impact to markets, regardless of whoever is in power, is trivial. Given that the polls were pointing to an ALP victory, the market was not surprised by the result.
And as always, with political certainty comes the enforcement of key policies. So it will be interesting to understand which star stocks can benefit from these themes over the next year. For example, the Labor Party appears committed to renewable energy, storage, and grid infrastructure, and this should benefit star growth stocks like IGO, which is a miner that has exposure to nickel, copper, cobalt, and lithium. Lynas Rare Earths should also benefit from this green energy thematic because its products are used in electric vehicles, wind turbines, and rechargeable batteries. Interestingly, both of these stocks have experienced positive earnings revisions over the last 3 months.
Yes, and another area of interest lies in childcare, with the ALP increasing support for childcare subsidies, making it more affordable for families. This should benefit star income stocks like Arena REIT and Charter Hall Social Infrastructure, who lease their properties to childcare centres. And these stocks trade on a healthy forward gross dividend yields of about 4% and 5% respectively. And they are also expected to go ex-dividend in about a month's time.
Yeah, the Labor Party is also committed to increasing the rollout of full fibre to the premises for an additional 1.5 million Australian households, which is going to increase speeds for around 90% of these premises. This should benefit retail service providers like star income stock Telstra that can also earn greater retail margins from higher speed tiered products. Telstra is currently on a forward gross dividend yield of around 6%, and it's expected to go ex-dividend in the next 90 days.
And investors looking to find similar opportunities outside of our star universe of stocks can utilize our powerful stock filter tool. Here you can create your own filter and include a keyword in the business description, such as, for instance, lithium. Then you can add in fields like financial health, return on invested capital, earnings quality, 6-month share price change, market capitalization, and average daily trade for liquidity. Then sort the list by average daily trade in descending order, and you have your list. You can generate a similar list by searching for childcare or telcos under the business description as well. Okay, Jace, let's now turn our attention to some star stock highlights for this week.
Great. So over the last few weeks, we've had a number of questions on borderline star stock Codan, which is a maker of metal detectors and radio communications equipment. The stock has been under significant share price pressure over the last year, and this was on the back of heightened risks around the civil unrest in Sudan, COVID supply disruptions, and management uncertainty.
Yes, but earlier in the week, Codan provided a trading update, and it now expects its first half net profit of 50 million to be matched in the second half. This implies a full year net profit of around 100 million and is roughly in line with consensus expectations. As a result, the negative 3-month earnings revisions have softened and now is only down about 1%.
Short interest on the stock also remains low, but has been rising over the last few months. Higher short interest could lead to support for the share price, as short positions could potentially unwind on the back of the positive news. The stock is trading in a bearish trend on both the SD Max and SD30 TSR, so trend-sensitive investors should stay on the sidelines until a more positive price trend emerges. However, those who believe that the company will be able to satisfy consensus expectations for around low single-digit earnings growth, they could view this as a potential opportunity into the company.
And also respiratory care manufacturer Fisher & Paykel, they released their full year result, which was in line with consensus expectations. However, the result was marred by a 48% decline in operating cash flows and a higher inventory spend as well, which culminated to a weak earnings quality ratio. The share price has also drifted lower after the company released guidance in March, which was below market expectations due to higher freight costs. This has also led to the negative earnings revisions down somewhat 13% over the last 3 months.
We have to keep in mind that the company was a beneficiary of COVID because many patients were admitted to hospitals with respiratory problems. However, the demand has slowed considerably, and the moderation with its return on equity and earnings growth meant that Fisher & Paykel no longer satisfies Lincoln's growth criteria.
Yes, and meanwhile, trend-sensitive investors should remain on the sidelines, given that the stock remains on a bearish trend on both the SD Max and the SD30 TSR. Okay, looking at our corporate calendar for the week ahead, it'll be a quiet one on our front with no star stocks reporting or going ex-dividend.
In terms of technical indicators, the recent volatility in equity markets, it's no surprising that we see a higher than average number of signals on Lincoln's technical indicators. Unfortunately, the technical signals this week were all bearish. So for highly trend-sensitive investors utilizing the SD Max, which is the Stock Doctor Moving Average Crossover, we have Alkane Resources, ANZ Bank, Cogstate Limited, Charter Hall, CSR, IGO, JB Hi-Fi, MetalX, Macquarie, Objective Corp, Promedicus, Woodside Petroleum. Now, meanwhile, we've got Premier Investments, Wesfarmers, and Super Retail Group, and these three companies breached the SD30 TSR, which is the Stock Doctor 30% loss from its highs or gains from its lows.
In Under the Microscope this week, we take a look at casino and online gaming company Aristocrat Leisure. Its first half result was above market expectations. And if you can recall, late last year, the company raised 1.3 billion in equity to acquire UK-based online gaming company Playtech, but the deal fell through. And a few investors are now wondering how the company was able to sustain its return on equity at 24%, despite the significant dilution to its equity base from the capital raising.
It's a good question, Kien. The equity raise itself was less than 5% of total shares on issue, so the absolute dilutionary impact was quite limited. Meanwhile, the company was able to report a solid EPS growth rate of around 81%, which more than offset the dilutionary impact of the capital raise. As such, this led to stability in its return on equity ratio.
Jace, I also noticed that the company's net profit margin also increased significantly from 13.5% in the prior period to 20% now. And the lift in net profit margin appears to be driven by higher contributions from the American land-based gaming segment, which included the poker machines and operates at higher margins compared to the digital segment. In addition, there was a reduction in the effective tax rate as well due to the recognition of tax benefits.
That's correct, Kien. In addition, with the failed Playtech bid and excess capital, management remains on the hunt to acquire online real money gaming platforms, which is effectively online casinos. But without a target at this point in time, Aristocrat plans to deploy 500 million of the 1.3 billion capital raise towards an on-market share buyback, and this should help support the share price in coming periods.
And given the strong first half result, several analysts have now revised their full year earnings guidance expectations upwards. And this is reflected in the financial year 22 EPS forecast revisions of around about 10% over the past 3 months.
But you'll also notice that the share price has weakened over the last 6 months, and this was due to difficult operating conditions, including the relocation of its Ukrainian workforce, an industry-wide drop in mobile game demand after COVID restrictions were lifted, and also global supply chain crunch. The stock is trading on a bearish trend on both the SD Max and SD30 TSR, so trend-sensitive investors should perhaps remain on the sidelines until a more favorable price trend emerges.
Yes, but despite these headwinds, the company is accelerating its entry into the online gaming market and intends to launch in the US by the end of calendar year 2022. In addition, its large cash war chest should provide growth opportunities from potential mergers and acquisition activities. For long-term investors, this could represent the opportunity, especially given that it is trading at a slight discount to valuation. Last month, in our Taking Stock video on the 22nd of April, we discuss the impact to shareholders of the merger between BHP's petroleum business with Woodside. Today, we want to extend this topic and provide further detail around this transaction, specifically with regards to the recent share price movements. Firstly, Woodside Petroleum, they've now changed their name to Woodside Energy with the ticker code WDS. And on Wednesday this week, on the 25th of May, you would have noticed that the share price of BHP fell by about 10%. And this was the result of the stock trading ex-dividend with its in-specie dividend. Now, an in-specie dividend is a dividend that is paid in assets rather than cash.
Yeah, it's a good point, Kien. So eligible BHP shareholders received one Woodside share for every 5.534 BHP shares that they owned. This means that the share price of BHP declined by around 10%, and this is to reflect the remaining proportion of the business. In Stock Doctor, under Golden Rule 4, we have adjusted the historical share price of BHP, and this is why you don't see the 10% decline in the share price that occurred on Wednesday.
Yes, but what about Woodside Petroleum? Why didn't the Woodside share price react to the merger? Well, for Woodside Energy, gaining around 27 billion in assets was diluted by the extra 915 million Woodside shares that was issued to BHP shareholders. Therefore, the net effect to the price per share was effectively zero, all things being equal.
That's a good point, Kien. The Woodside shares will be allocated on the 1st of June 2022, and it comes with a 30% in franking credits. Meanwhile, those who own less than 1,000 BHP shares can receive the dividend in cash, and this is through a share sale facility, but the forms for that have now completed and were due on the 26th of May.
So in the short term, Jace, the share price of Woodside Energy, it can be vulnerable to some weakness because of the potential sell down by BHP shareholders, possibly due to ESG, environmental, social and governance concerns. However, longer term, Woodside should benefit from 400 million in synergies and a reduction in their debt, which should improve its financial health.
Meanwhile, the divestment of coal and oil from BHP should allow the company to reduce its capital expenditure, improve its financial health, and focus on growth opportunities across green energy initiatives with copper and nickel.
And once the Australian Tax Office has released its class ruling, we will provide a help file with instructions on how to account for the BHP Woodside merger in your portfolio, where you'll need to use the new reconstruction feature. Thanks, Jace, for your time today. It was a pleasure to have you on board again.
Pleasure's all mine.
Also, remember to tune in to our Lincoln Live webinar where Tim Lincoln, together with Matt and myself, along with Robert Manfrey, will be there to answer your questions on stocks, strategy, and how to use Stock Doctor. We hope you can make it. Well, to summarize, volatility and election outcomes can create opportunities for investors, and Stock Doctor can provide the tools you need to help you look for those opportunities. Take care and have a happy, healthy, and prosperous week, everyone.